What up, guys? It's March 2nd, and let's go over this market alert. I want to go over a lot of things on this video because there's a lot of forces that are pulling this market up and down. We're sort of this kangaroo market, not kind of like bearish all the way, not bullish all the way, kind of like up and down, up and down. If you guys are in the market, you've seen it, you've felt it. So let's talk about that. But before we do, of course, please hit that like button and subscribe. Definitely appreciate your support. Hopefully you learned something from this and we have some fun in the meantime. Okay, let's get into it right now. So here we go, guys. We got the Dow, S&P, NASDAQ. Excellent day today. Dow 1.79, S&P 1.86, NASDAQ 1.62, lagging those two indicators. But we have the Russell 2K. The Russell 2K is your small cap stocks, mostly small cap value names, small cap growth companies that are outperforming in the day. This is what we want to see. For my portfolio, I need these two guys to move. That's what I need. I'm not so much leveraged to the S&P or the Dow by no means. The Dow least of all. So what I need for my purposes is the NASDAQ and the Russell 2K to move. If you have stocks in your portfolio, you have to know which index you're leveraged to, okay? So make sure you look at your portfolio, you know where you are, okay? Now moving on, we got the VIX over 30. We're going to talk about that specifically. And oil, WTI 114, unreal expensive. Brent 116, even worse. For the European companies, it's usually the other way around. Usually WTI is higher, but not this time around, okay? And natural gas and the other energy indexes here, okay? So pretty good overall as far as the stock market, not good as far as the VIX, oil, and also we're going to talk about, what are we talking about? We're talking about bond rates, of course. We're talking about those as well, okay? But let's go over essentially the forces of this market and what's going on, what's pulling us in a certain direction. Let's go over that. All right, so here's some factors to consider for investors. Okay, we're going to start with, of course, Russia and Ukraine and the effect of the sanctions that the Western countries are pulling on the Russians. Of course, we know that the Russians are hurting these sanctions. And if you're in the market, if you follow stocks and you follow my Instagram, you follow, investors in Twitter, or Instagram, social media, you know that Russian stocks, ETFs here in the U.S., Russian stocks in the London exchange, in the CAC, in the French stock exchange, in the German stock exchange, in the Italian stock exchange, those stocks have been demolished. Okay, I'm pretty sure that these stocks that were worth $10, $20 a share are now worth probably cents, penny stocks. So if you had a significant amount of money, you could probably buy a big chunk of these companies at this point for a large discount. You'd be betting, of course, that everything's going to return back to normal, which is tough to say, but it is a big risk. But I don't recommend that at all. I have a hard time buying Chinese stocks, much less Russian stocks or Russian ETFs. So nothing for me there, guys. So the point here is the effect of sanctions on Western countries. So the effect of oil going higher, the effect on banks, the effect on the SWIFT system. That's all that's very tough. Things are tough to kind of understand because they're so intricate and they're so above the level of a retail investor. But essentially, we know in the companies that we own for our portfolio that they have no Russian exposure. So I'm not worried about the Russia situation. I'm using anything based on the Russia situation as a buying opportunity for the portfolio. So as far as the portfolio goes and our intentions, no Russia exposure, but you should definitely look at your portfolio to see that accounts. If you own oil stocks, if you own banks, you may have some exposure there. So take a look and make sure you know what you're doing, all right? Now, moving on, we're going to go to the State of the Union address. And this was yesterday, of course. If you saw the State of the Union address, you saw that there's not much there that was in a way of economics. I guess there was a lot of things on economics, but nothing that impacts your specific stocks or your specific choices on what stocks you chose. Unless you own Ford. If you own Ford, this was a great speech by the president. If you own semiconductor stocks, good speech by the president, specifically Intel. And I was kind of disappointed that he didn't mention Lisa Su of AMD, which, if you mention one CEO, you kind of have to mention a couple of them at least. He didn't do that, whatever. But if you're an Intel shareholder, you probably saw a little bit of a boost from that. And Pfizer. Other than that, as an investor, I don't see much difference there from the State of the Union address, all right? Now moving on, we got the Federal Reserve and interest rates. Huge topic. So let's get into this one. So I'm bringing up a 10-year chart. Actually, not a 1-year chart of the U.S. 10-year Treasury bond yield. We can see in this chart that it's reached over 2 as far as bond yields, 2% or 2 points, 2%, but it's fallen to 1.85. That's a significant fall, guys. That's that's what, a 7% fall over the last, couple weeks. So why is this happening? Because remember, we've been selling off because interest rates are expected to go higher, and having a more hawkish Federal Reserve. What's changed that? Let's go over that. Let's go over what's changed there. And what's changed that, of course, is Federal Reserve Chair Jerome Powell giving testimony before Congress, before the government today, and saying, hey, this Ukraine war is making things more uncertain. Implications for the U.S. economy are highly uncertain from this war. So essentially, we're not going to go crazy and we're not going to go overly hawkish. Some people are expecting a half a rate increase in March on the interest rate, up 4%. Some people are expecting 5 to 10 rate hikes this year. This war is causing the Federal Reserve to be more cautious, more dovish, which means that 10 bond year is going to go lower because now the expectation of hawkishness is lower because of this conflict, because of what the Fed chair said today on the Hill. So for investors, this is a positive because it kind of pushes back the schedule of hawkishness to later on in the year, allowing equities and stocks to soar. So there's the impact of the Federal Reserve and interest rates. Moving on, we're going to move on to the volatility index, the VIX, right? What's known as the VIX, V-I-X. And let's talk about that. That's another really, really important topic. So here I want to pull up a 5-year chart of the VIX, the volatility index. And you can see here there's certain spikes that you're going to find a little recognizable. You can see this big old spike here, and this reflects the pandemic. That's March 2020. That's when the pandemic hit, when everybody was panicking around that March timeframe. And what were we doing here for the account? And we weren't public. We didn't have a YouTube channel. We didn't have none of that. But what were we doing right here? We were buying stocks. That was the most important thing we were doing around this time, around March 23rd. I remember it like it was yesterday. We buy stocks here. We're not buying stocks here, guys. That's what we have to understand. When the VIX is at 10, right, we could be buying stocks all around and being picky. But the lower the VIX is, that means the more stable the markets are, which means they're going to be higher priced. So we have to wait for these spikes in volatility in the VIX, specifically when they're over 30. That 30 line here, if you see, that's a very important line. That is the time to be buying equities because that means the markets are overly bearish, overly negative. We're not waiting for good times in the economy, for boom times to buy stocks. We're waiting for bad times to buy stocks so we can propel higher and just rocket higher when the bad times stop and the good times arrive, okay? I hope that makes a lot of sense. And I'll give you another tool to help you look at this that I think is very useful. And I give you here the CNN Business Fear and Greed Index. This is a very, very good gauge to know where the market sentiment is. Right now, it's showing 24 for extreme fear. So if you think about it this way, you don't want to be buying stocks when the market is extremely greedy. You want to buy it when there's blood in the streets. That is when we want to be piling on stocks. And on this side, you want to be very picky. Especially if you're buying stocks, you got to really do your work, really do your due diligence, and pick something that nobody else is seeing out there. Other than that, you're more than likely overpaying for the stock that you're buying. More than likely, more people here are going to be actually placing their bearish bets. So when the pendulum swings back to extreme fear, they can make some money with some put options, some bearish options out there. On top of this gauge here, we also have junk bond demand, put and call options. I think this one is very important. Put and call options, okay? If we don't know what that is, put option is betting that a stock is going to go down to a certain amount by a certain date. Call option is that a stock is going to go up to a certain amount by a certain date. But we can see here that we're still in put options among the highest levels of put option buying seen in the last 2 years. That right there is overly bearish. This is another indicator that stocks need to be bought, okay? We also have stock price strength. We have market volatility. That's the VIX right there, and it's showing us a very elevated VIX and other things here, stock price breadth, market momentum, etc. So this CNN business gauge here, I think is very useful, specifically for beginner investors to show you the overall sentiment of the market. Now, the last factor I like to discuss is oil prices, guys. That's what everybody's talking about nowadays. Every time you go to the pump, every time you hear somebody talk and complain, right? Most people blame the president. Fortunately, guys, I got to tell you, that's not the case, right? And I want to kind of explain this to you because as investors, we got to look at data. Sentiment plays nothing on it. Blaming it on one person really does nothing for you. So let me show you the data behind this so you can see kind of where the trend is going on oil prices so you can make an educated decision. I'll start with the chart or WTI crude oil. So here we go, guys. Here's a chart of WTI crude oil here from the New York Mercantile Exchange. We see here that all the way to maybe 2003, oil was pretty steady. Not a lot of stuff going on here. We have here in the kind of early 90s, late 80s spike. But we also have the Great Recession right here. We have the pandemic right here in this dip when oil went to negative prices on that spike downwards. But now, after that, the demand for oil, for energy has soared, and we're at $114 a barrel. So, in my view, the oil is a lot like the VIX. You don't want to be buying stocks when things are so steady, right? When these dips happen, right? Right here, we're all buying stocks. Maybe here in the pandemic, yeah, we were buying stocks, of course. But the demand for oil, the supply and demand equation, always has something to do with the sentiment of the market. So it's always a good shot to be buying stocks around these levels. It's probably the most strategic thing you can do if you're not one of these pickers that actually does his due diligence. If you're just kind of like a trader and looking for the weather of the market, the VIX, WTI, is a great indicator as to what you should do if you're not too much into these markets as far as a actual fundamental investor, more of a day trader or swing trader. Now here's the data that I promised you guys on oil. And very simple, oilprice.com/rig count. And here you see the rig count in the United States of America. Very simple, guys. Here's you have this historic data, how many rigs are open in the United States. But here you guys can see that this is a 5-year chart of rig counts. We have here in the green all rigs, and then we have oil rigs here in the blue. So we can see here that around March, here we see, where's March 2020, right about here, March 2020. That's when the pandemic strikes and oil goes negative in price. And oil producers say, hey, we need to stop producing oil because it's falling too much. We need to keep the price up. So we have to shut down oil rigs. And boy, did they shut them down. Now we see here, if you see this correlation here between the price of crude, which is right here, and the amount of rigs that are open, we're going to see here that in March of 22, you have about half of what you had in February of 2019. So when we're blaming one man for the price of oil, why are we not looking at charts? Why are we not looking at data to show us that oil companies have not gone back and are half at the level or producing oil at half of the capacity they had in 2019? If you're trying to say, hey, Joe does this, Joe has the, his hand on the knob and he can twist the price whenever he wants, why doesn't he do it now, right? Why? Joe here on 2021, that's when he took over. Right here, guys. So the trend is positive. It's just that the oil companies are focusing on shareholder returns and dividend returns. When the spread is here to here and here, when that spread is higher, they make more money. But there's also a lot of equations because they have to compete with Saudi Arabia. They have to compete with Russia. And we're looking at those numbers. As far as production levels, we see here that the United States is the biggest producer of oil in the world, 20% of the world total production, right? And then we have Saudi Arabia and Russia. Russia produces 11%. That's still a significant number, and they're not shelling out oil. They're just not doing it because of the Ukraine situation. So that's why we have oil at such an inflated price. However, stocks are still roaring. Traders know this. Wall Street investors know this. So that is why we're not getting demolished. The other side of that too is that when we get oil price this high, demand destruction happens. People tend not to drive as much. They tend not to travel. So everything is going to balance out because of supply and demand. So I'm not afraid of oil prices at all. I think, if anything, oil prices being this high are a great indicators, or it is a great current indicator that stocks should be bought. So that's my little spiel there about oil, the VIX, and all these indicators that you should be looking at as to the weather of the market and to know whether you should be buying stocks. I am as invested as I've ever been in the stock market. I am very bullish towards the future. I feel that companies are doing great. I feel that the numbers they're reporting are good, and everything in the sentiment is backed by earnings. I think that the market is overly bearish, and I'll give you guys a quick example before this goes on for too long, and I'll show you the actual earnings from Nordstrom, guys. Nordstrom reporting EPS, GAAP EPS of 123, beats by 23 cents. That's a huge beat by Nordstrom. That is a surprise beat. Revenue of 4.49 billion, beating by 130 million. The expectation for Nordstrom is you're going to get clobbered by inflation. Not the case, guys. These guys are making money. These guys surprised Wall Street, and their stock felt the change. Look at this stock price, guys. And here it is, guys, where you look at this, Nordstrom up 37%. 37. I mean, I don't say 30 easily. I would say 30 if it wasn't that impressive, but it is very impressive. So 37% move to the upside today. That's monster, guys. That's monster. You cannot argue that the street was not surprised by these numbers. So when I say that the market, the economy is supported, or the actual Wall Street is supported by earnings, take a look at Nordstrom. Take a look at Signet Jewelers, which we've talked about in the past, with 37% year-over-year same-store sales. Earnings matter. Earnings are good, guys. Now, to close it out, I want to go over just a little bit of portfolio news here before we take it, or we call it a night. Here's the portfolio so far, and here's our moves for the day. Let me kind of fix this. We have here Wynn Resorts, Ford moving almost 10% for the day. Phenomenal moves, and some great movers over 2%. Great day for the account. But we have some news here. We have Ford announcing that they're splitting their businesses into Ford Blue for their ICE vehicle business, and Ford Model E for their electric business. Essentially, like we talked about in the Ford call, they're going to use their ICE, their internal combustion engine business, to finance growth and profitability in their electric business. We also have DraftKings here. Where's my DraftKings? Where's my Donkey Kong? DKNG, Donkey Kong, what we call it. Investor Day tomorrow morning, early, 5 in the morning Pacific time. If you're in the East or in Central, a little bit easier for you, but I'll wake up very early to listen to their first ever Investor Day presentation. Expect to hear about profitability in their states that became, or in states that legalized gambling in 2019, because the path to profitability in each state is lasting about 3 years. We're going to talk about customer acquisition costs, which is always the issue, but we're also going to be talking about how competitors are dropping off, and DraftKings' strategy of spending to acquire customers is actually a very smart strategy and not a detriment like Wall Street, or most of Wall Street, thinks it is. We also have Wynn Resorts news on that front. We have Macau, or the Chinese government, kind of mulling over ending their Rona Zero policy, their pandemic, or when one person gets infected, everybody has to quarantine. They're thinking about ending that and lifting mandates and doing all kinds of things that are not impinging on tourism. So that's a positive for Macau. That's what we see Wynn Resorts roaring today. We also have Marvell Tech. This is a position that we just re-entered in the account. Very small position, probably the smallest position in the account, but it does increase my semiconductor exposure, which I'm always looking to do. So right now we have Marvell, we have NXPI, and we have AMD roaring on the day, but Marvell Tech reports tomorrow. NXPI and AMD have already reported amazing quarters. Very happy to have our semiconductor exposure here in our portfolio doing well today. And to close it out, we have Teladoc. We had news that Teladoc is expanding with Alexa. Now you'll be able to say, hey, Alexa, I need to talk to my doctor, or Alexa, I need to talk to a doctor through the Teladoc app. So that's great. It's an expansion of the business. Very positive. We don't see Teladoc roar today, but that's because it roared on those news yesterday. Okay, so if you guys have any questions, that'll be all for today. Follow me on Instagram, Twitter. Follow me on the Discord. I'll leave the links below. If you guys have any questions about what we talked about, please let me know. I'm here to help you. Peace out.